So the next question that we need to work on for today's lecture is 18.4. So we're going to work on exercise 18.4. So 18.4, let's read the question and see what the question is asking us to do. I always read the instructions first before I could read the question. It's saying for each year, one, identify the amount of reversing difference originating or reversing during the year, and second, indicate the amount of temporary difference at the end of the year. So what happened is there is a one amount that is the difference between the accounting income and taxable income, and we wanted to know where it's originating, where it started from. So if I were to look at it, we always think of it, we start off with an accounting income. Accounting income again is created using IFRS standard or ASPE standard, and taxable income is created using an Income Tax Act. So in this question, they told us that there is a one difference. So we started off with 160,000 in your accounting income. What we are going to do is we are reaching to 245. So there is one difference. So they told us it's not a permanent difference. It is a temporary difference or a reversing difference. So it is a reversing difference. So what is the amount, difference? First we needed to know difference, and then we needed to know what is the amount. So if I take the difference between the 160 and 245, and the difference between the both number is 85. The question is saying the reversing different originating or reversing during the year. So in this case, it started from this year, so it's called an originating. So they're saying, is it originating or reversing? So if it starts from here, it originated here, so it's originating. So this difference is originating. It's going to reverse in the other years. So let's see what's happening in the year 2021 and year 2022. So what happens in year 2021? We have an accounting income. Our accounting income is 139,000, and then from there we needed to know what is your taxable income. They told us in the question the taxable income is 121. So this is 121, and this case there is a difference. What is the difference? You take the difference between the 139 and 121, and the difference is 18,000. So in this case, if you look at it, it was a positive here. So this is where the difference started from, and that big difference, now what we are doing is we are minusing it here. So now we're reversing that difference. So in this case, this 18,000 is called a reversing. So this is a reversing difference. Then we look at the 2022. We have an accounting income. We started off with 131,000, but my taxable income is 125,000. So difference between those both numbers is 6,000 difference. So what we are doing is minus the 6,000, and is also a reversing difference. So what we did is we answered the questions for the part A. Is saying as one, identify the amount is reversing difference originating or reversing in the year. Then they saying indicate this amount is a temporary difference at the end of the year. Of course, if it's a reversing every year, it is a temporary, and it is a deductible difference. So let's see what the B part of the question is saying. Indicate the balance in related to deferred tax account at the end of each year, and identify it as a deferred tax asset or a deferred tax liability. So now we know that difference between the accounting income and a taxable income is a reversing difference or a permanent difference. And if it's a reversing difference, it will create a deferred tax asset or a deferred tax liability. So we want to know, did we create a deferred asset or a deferred tax liability? So in this case, if you were to look at it here, if it's a plus, we created a deferred tax asset, and when what you're doing is you're reversing that asset, and then you're creating in other words, if it's a negative number, it is a a liability, but when we look at it, we're combining the entry. That's what we're doing. We're combining each entry. So if we're combining each entry, what we had to do is, now let's take part B. We want to know what is the balance in your deferred tax asset / liability account. So how do we do that? Our difference is positive. So in this case, it's if you were to do a journal entry. So they're saying to prepare the journal at the end of each year to record the current and deferred. So what we'll do is we'll answer B and C together. So first we wanted to know is what is the B, and I'm going to try to do B and C together because we wanted to do the income tax entry. First entry is debit your current income tax expense, and the credit is your income tax payable. When you have an income tax payable, you have to take taxable income. In this case, our taxable income for the first year, our taxable income is 245,000, and you multiply by the tax rate. Did they tell us what the tax rate in the question? Yes, they said the tax rate is 30%. So if I multiply by the 30%, I will get a rate. I will get an amount. In this case, the amount will be 73,500. So I will debit my current income tax of 73,500 and credit my income tax payable for the same amount. And if I have to do a deferred tax entry, so we're doing B and C together, and I'm going to answer that question. If the difference is a positive difference, we're creating a deferred tax asset. If the difference is a negative difference, we're creating a deferred tax liability. But how would we do an entry? In this case, it's a positive, so it's a deferred tax asset. And I showed you I'm going to create, I'm using the same account so that we don't need to, we don't get confused in the second year. So we have a deferred tax asset / liability. And then what we're going to do is our difference was 85,000. So 85,000. So I'm going to take the 85,000 multiply by the tax rate in that year. In this case, it's a 30% tax rate, and I'm going to get a deferred tax. My debit is deferred tax asset / liability. So it's going to be 25,500. I'm going to make your life easier because most companies, what they do is they wanted to create a one account for asset liability, one account for expense and benefit. And if that's the case, all you needed to do is, if you're putting a debit, it's an asset. If you're putting this account as a credit, then it will be a liability. So, and then your credit will be your deferred tax. If it's an asset, it will be a benefit. In this case, it will be a benefit for the same amount, 24,500. So let's do the entry for the year 2021, and then we'll do the entry for the year 2022. So the first entry is for the income tax payable. So you're going to debit your current income tax expense. And how do we calculate that? You take your taxable income. In this case, my taxable income is 121,000. The rate is same for each year. So for all years. So the question is saying all the years the tax rate is same. So you multiply by the 30%. So in this case, if I multiply by the 30%, I have a current income tax expense of 36,300, and this is my debit entry, and I'm going to credit my income tax payable. Tax payable for the same amount, and it's a credit, and it's a 36,300. Now we know the difference is a credit. In other words, if you were looking at the solution will to reverse that whatever asset account we created. Now we have to reverse it. In this case, we have a liability, and you're going to debit the expense. So debit entry will be your deferred tax benefit / expense, because it's you're creating a liability. If it's a liability, it's an expense account, and you're going to credit deferred tax asset / deferred tax liability account. I'm doing a short form so that I don't have that much room. What I'm going to do is 18,000, and you multiply by the 30%. That will give you a 5,400. So that's the reversing difference. So now let's do the same thing for our 2022. First, we're going to do the current income tax expense, and will be your taxable income, which is 125,000, multiplied by the tax rate. In this case, the tax rate is 30%, and then it will be a debit of 37,500. And then what we do is credit your income tax payable. Income tax payable will be for the same amount, and it's a credit, and this is a debit of the same amount, 37,500. Now we have a reversing difference. It's a negative difference. It originated here, so if it's a credit, it's a liability. So we are going to have a same entry. If it's a liability, you have an expense. So if you're debiting something, it's an expense. So it's a deferred tax benefit / expense, and credit your deferred tax asset / deferred tax liability. The reason I'm combining this is that at the end of the year, you are going to have an asset account, or you're going to have a liability account. If you have an asset account, you are going to, if you have an asset sitting on the debit side, it will be sitting under the balance sheet under the current assets. If it's a liability, it will be sitting under the liability side. So the difference here will be 6,000 multiplied by the 25%. 6,000 times the 2,500 will give me 1,800. So that will be my 1,800. So what we did is we did the answer in A. So if you were to show, and I did B and C together. If I were to do a journal entry or show you as a T account, so you have a deferred tax asset / liability account. If you look at it, you debited first 25,500. When you did the second entry here, what we did is you credit that account, so you credit the 5,400, and then when you did the third entry, you credit the 1,800. So we still have some deferred asset or liability account to be used in the future. So that's what we are going to do, to be used in the future. So whatever is the balance to be deferred for the future, so what we're going to do is we're going to be using it in the future. Now the next part of the question that I assigned you guys to complete is 18.7. So let's see if we could do 18.7. And with 18.7, what we are going to do is, I'm not going to ask you to do all the questions, all the parts of the question, but we are going to do only B, C, and D. So what we're going to do is we're going to do B, C, and D. So that's what I'm going to show you, B, C, and D. So why I'm skipping A, because A, I don't want to show you this till we finish taking up all the homework for this. So now our next question that we had to do was 18.7. So let's do next one. Let me erase what I wrote. Now, since you already copied everything down, so I'm just going to take a couple minutes to erase it. So let's do exercise 18.7. So next exercise we have to do is 18.7. So in 18.7, there's a lot of information there, but we're going to make it simple as possible as we can. So in this case, Saika Tar and Gravel Limited operates a road construction business. In its first year of operation, the company won a contract to build the road. So they're going to be building a road for a municipality. It is estimated the project will be completed over the 3 years. So this project we took on will take you 3 years. Now, they're saying that Psycho uses a percentage of completion method. So for the accounting purposes, for IFR and ASPE standard, for the accounting purposes, the company is using IF. For the accounting purposes, you could use ASPE or IFRS. What they're using is they're using a percentage of completed method to record your revenue and your expenses. But IFRS recognize the percentage of completed, where the Revenue Canada CRA does not recognize the percentage of completed method. They only recognize completed contract method. Completed contract method, if they only recognize that. So what we needed to know is we recognize the gross profit at the end. So CRA recognize only the completed contract method, not the percentage of completed method. So that's what they're saying here. So revenue for long term for the tax purposes in order to postpone the tax on such revenue for as long as possible. SICA uses the completed contract method. So they told us to that CRA, for the CRA purposes, when we're calculating our tax payable, we're using a completed contract. For the accounting income, when we calculated our accounting income, we used a percentage of completed method. So there's a lot of information there. We only need to pick what we needed to pick. Otherwise, it makes it complicated things, makes it very complicated. Now, what do we start? The B part is to calculate the taxable income. That's what we are learning in this. We always start with an accounting income. From the accounting income, we're converting that accounting income into a taxable income. So what did they tell us? What was my accounting income? Yes, they told us income before income tax for the year December 31st was 2020 was 195,000. So we know that what we did is we started off with 195,000, and between we have a permanent difference and we have a temporary reversing difference. So let's see which ones are permanent and which ones are temporary or reversing difference. So we might have both or we might have one. So it's called the reversing / timing difference. So let's look at the first one. They're saying that the question even say that there's two reversing difference. So if in this case, if there's only two reversing difference, we don't have any permanent difference at all. So we have reversing difference. So if I look at it now, first one is the difference between the we have a percentage of method to record the revenue. The other one is completed contract method. So let's look at that. When you're looking at that, if you look at it, we only look at two accounts. So we have revenue and expenses. We know revenue minus expenses is your gross profit. So in this case, your gross profit, I'm just going to put gross profit. What they recorded was that under the percentage of completed method. So percentage of completed method is used to calculate your accounting income. In this case, you take the revenue minus the expenses. Anything that goes on the income statement, that's the only accounts that we're looking at it at this point. So revenue minus expenses, our revenue was 550,000 and our expenses are 350,000. So we would have in our accounting income, we would have a gross profit of 150,000. Now we don't pay taxes on this gross profit at this time because we're not Revenue Canada doesn't recognize percentage of completed method. They only recognize the completed contract method. Since this is the first year, our gross profit under the completed contract method will be nothing. So under the completed contract, we do not recognize the profit till the project is completed. Since this is the first year, the project is not going to complete. It's the first year. The project is not going to complete 3 years from now. So in this case, we take out the profit that we recognize in our accounting income, and we do not report any. We do not report any of the profit because project hasn't been completed yet. So this was the first difference. And the second reversing difference is, I look at it as a depreciation. Sometimes they tell you the depreciation expense and sometimes you kind of indirectly calculate it. So if they don't tell you what your difference in the depreciation is, now if you look at it, can we calculate it? Yes, we could calculate it. How are we going to calculate it now? If you look at it now, you have an equipment and you have an accumulator depreciation. If you look at it, difference between those two, equipment minus the if I look at it, I'll erase this. We have an equipment that is given to us. Equipment goes onto your balance sheet minus your accumulator depreciation will give me a net book value or carrying cost, carrying value. So in this case, our equipment cost is 1.1 million, and our accumulator depreciation is 70,000. And then what we have is we have a accumulator depreciation. In this case, another way of looking at it, if this is first year, whatever my accumulator depreciation will be, another way of saying is my depreciation expense. So since this is the first year, so the whatever is the accumulator depreciation will be debit the depreciation expense, credit the accumulator depreciation. I was going to show you the deferred taxes, but I don't want to show you that till later. So we know if they were to use the accounting terms, accounting method of depreciating this asset, our depreciation expense will be 170,000. So whatever the depreciation we taken, we have to add back the depreciation that we have taken. So then, because it's an accounting depreciation, we add back it. If we add it back, it is a plus. And then what we have to do is we minus any CCA. So do we know what the CCA is? Since this is the first year, the cost that we started off with is 1.1 million, and then what we have is we have a UCC now is we have a UCC is 980,000. So we must have taken some CCA that in order for us our UCC is to be 980,000. So if that's the case, you take the cost minus your UCC will give you your X. In this case, the X will be 120,000. So 110 minus your 980 will give me 120,000. So in this case, that is my CCA that I should have taken. So the CCA is allowed for the revenue calendar purposes. So if CCA is minus, you add back the depreciation for the current year. So you add back the depreciation, you minus your CCA. So the question said that there is only two differences. So we already taken one difference, and this is my this is my second reversing difference. Since there's nothing else is happening, they're saying calculate the taxable income and calculate the income tax payable. So when you're calculating that, you take your accounting income, you subtract your permanent difference, subtract your reversing difference. Once you've done that, you calculate your taxable income. In this case, when we are calculating your taxable income, you take 195,000 minus the 150,000, add the 170 and minus the 20,000. Altogether will give me an answer of 95,000. And first entry, if I were to do it's saying prepare the journal entry. So let's prepare our journal entries. Journal entry stays the same. So how I do the journal entry: first entry is your current income tax expense, and then income tax payable. In this case, when we calculate our income tax expense and our income tax payable, we take our taxable income. In this case, taxable income is 95,000, and our rate, they told us in the question, is 25%. So multiply by the 25% will give you your current income tax expense. In this case, my current income tax expense is $23,750. So that's our first entry. Our second entry is for the we already done an entry for the current expense. Now we have a deferred taxes. So when we have a deferred taxes, in this case, the way I do it, when you're doing it, so this gives you a minus 150,000. This will give you a positive 50,000. So in other words, if you look at it, this will give you a deferred tax liability, this will give you a deferred tax asset. But what we're doing is we're combining, we are trying to combine the entry together. If we're combining it, so you take 150 minus the 50 will give me a balance of 100,000. At that balance is a negative balance. So if it's a negative balance, it's a deferred tax liability. So let's create let's do the entry. We have a deferred tax expense, but since we are using a one account, and I'm going to put it in here as a benefit. Then we have a deferred tax asset slash deferred tax liability. If I'm putting this account as a credit, it will be a liability, and we said that this account is going to be a liability account. What is the amount? Whatever is the difference. In this case, the difference was 100,000 multiplied by the tax rate. In this case, the tax rate we have is 25%. So you're going to debit your expense, deferred tax expense. In this case, it's at 25,000, and your deferred tax liability here is 25,000. So now what we did is we did your journal entries, and then they said what else we had to do. Prepare the income statement for 2020 beginning with income before income tax. So when they're asking you to do sorry, I'm going to enlarge it. So they're saying prepare the income statement for 2020 beginning with the line income before income tax. So let's start with the line with the income tax. So income before taxes, that's my accounting income. In this case, before taxes is 195,000. So you could have an income or you could have a loss. In this question, we have an income before taxes. Then my next heading, like I showed you, is an income tax expense. In this income tax expense is just a heading. In this heading, after this heading, we could have two things. We could have a current income tax, which if you have an income, you are going to have a current income tax. So your current income tax, where am I going to get that current income tax? We already did a journal entry. So our current income tax in this case was 23,750. And then we have a deferred tax expense, or we have a deferred tax liability. So if you have a debit entry, we have a deferred tax expense. So in this case, it's deferred tax expense, and if it's a deferred tax expense, we have 25,000. Where did I get it? I already calculated 25,000. If it's a deferred tax expense, you're going to add these two numbers together. You could have a benefit too. If you have a benefit, you will be minusing it here. In this case, you add them together, and then it goes to the side, 48,750. And since this is an income tax expense, it is a minus from our income before taxes. Then after that, it will give you a net income. So my net income will be 195,000 minus your 48,750, and you'll get a net income of 146,250. Now the I'm not asking you to do it for the test. For your part F, repeat all the balance sheet presentation in part A. In other words, we're just showing them how what will be sitting at the end of the year. At the end of the year, what do we have? We created a liability. So in this case, if you have a liability on your balance sheet, that will be the answer to our next one, which is your E part. The answer to the E part is you have a liability, so it's going to be sitting under the balance sheet under the liability side. So we have a liability is your heading, and then under that liability you're going to do deferred tax liability, which is going to be your 25,000. So that's how much is going to be shown in your balance sheet. So that's what the question is asking us to calculate. So now next part of the question is we have to go to exercise 18.8. So let's see if I can erase this part first, and then we are going to go to 18.8. So my next exercise that we have to do is 18.8. So let's see if we can read the question and kind of make sense out of it. Sometimes, it makes it a little bit harder when they ask you the question. What we are going to do is I'm not going to ask you to calculate the balance what was the previous year, so because that makes questions a little bit more complicated, and then you sometimes find this course is a little bit hard. But if you're finding the course already hard, I don't want to kind of make your life more miserable than it is already. So in this case,